The year was 1937. The world, still scarred by the Great Depression, appeared to be healing. Streets were alive with the cautious optimism of progress. Factories hummed, markets were climbing, and the average citizen dared to hope again. Yet beneath this fragile optimism, a storm was brewing, silent, invisible, and deadly. The memory of 1929's catastrophic crash lingered like a shadow over the global economy. Families who had once trusted banks found themselves destitute. Farmers who had lost everything to droughts and debt struggled to rebuild. Governments worldwide tried to restore confidence through policies, programs, and propaganda, and slowly it seemed to work. The market climbed, unemployment dropped, and optimism returned. But this optimism was deceptive. On Wall Street, traders and bankers were confident, yet overconfidence is a dangerous companion. Brokers encouraged speculative investments. Small-town banks lent money beyond their capacity. Families invested their life savings in stocks that seemed too good to fail. For a moment, it seemed as though the wounds of the past had finally healed. But history, as it always does, reminds us that prosperity is a fragile illusion. The narration continues. Beneath every handshake, every confident smile, lay risk, greed, and the invisible thread of fragile trust. Subtle signs of instability began to appear. Some industries were overproducing, agricultural prices remained volatile, and banks were quietly tightening credit. Analysts who understood these signs often went unheard, dismissed as pessimists in a world desperate for growth. The global economy was like a delicate structure, and cracks were forming in its foundation. Imagine a clock, the narration explains. Each gear must move perfectly in harmony. In 1937, the gears of trust, finance, and public confidence were slipping. And when one gear fails, the entire mechanism trembles. Human stories make the abstract statistics of the crash painfully real. Families who had scraped together every penny to buy a small home or invest in a business suddenly faced bankruptcy. Communities reliant on a single factory or bank were left destitute. Children who had witnessed the despair of the 1930s felt it again as the economy stumbled. The crash was not just numbers on a ledger. It was shattered lives, lost futures, and dreams extinguished. Wall Street, with its ticker tape machines and bustling floors, seemed oblivious at first. Brokers shouted numbers, markets appeared steady, and the public clung to hope. Yet in quiet offices, economists and policymakers studied the signs of fragility. Debt was rising faster than profits. Investment bubbles were forming. And yet, the world marched forward as if these warnings were whispers in the wind. The crash of 1937 was not sudden, the voiceover continues. It was a slow-motion disaster, building silently through months of missteps, policy errors, and human overconfidence. By the time panic hit, the damage was unavoidable. Even governments who believed they had learned from 1929 misjudged the economy's resilience. Policies aimed at controlling inflation and balancing budgets inadvertently choked recovery. Banks that had survived the Depression were now vulnerable to smaller shocks, and investors, blinded by the lure of profit, underestimated the fragility of the system. The first tremors were subtle: small bank failures, dips in industrial production, sudden drops in commodity prices. These were signs that few recognized as warnings of a major collapse. Crowds outside banks in small towns whispered rumors of insolvency, while city newspapers carried the first ominous headlines. Panic was in the air, though it moved quietly, almost imperceptibly. The world was lulled by the illusion of security, the narration reflects. People believed that prosperity was permanent, that markets could only go up, and that human ingenuity could overcome any obstacle. But greed and complacency often blind even the wisest, and in 1937 that blindness would cost dearly. The cinematic vision of this era is vivid. Empty factories at dusk, their machines silent for the first time in months. Bank tellers counting dwindling reserves as anxious customers wait. Families gathered around radios, hearing the first warnings of market instability. Boardrooms filled with tension as bankers debate policies, smoke curling in dim lamplight. As Section 1 closes, the tension reaches its peak. The audience is left with a sense of foreboding, knowing that disaster is inevitable, yet powerless to stop the unfolding story. The narration hints that what happened then is not just history, it is a lesson repeating today, if only we dare to see it. Because the past is never truly gone, the voiceover concludes, it whispers through the cracks of every market, every decision, every human choice. And in 1937, those whispers became a roar. The crash of 1937 did not strike like lightning. It crept in like a shadow, unseen until it had consumed everything in its path. Unlike sudden market panics, this collapse was slow, methodical, and rooted in months of hidden economic fragility. The underlying causes were complex, a tangled web of policy decisions, market psychology, and human error. After the initial recovery from the Great Depression, the U.S. government decided to tighten monetary policies to curb inflation. Taxes were raised, spending reduced, and credit became scarce. Economists warned that the fragile recovery could not bear these sudden constraints, yet these warnings were largely ignored. Economics is not just numbers, it is behavior, the narration continues. Fear and greed are the true drivers of markets. In 1937, fear and overconfidence danced together, pushing economies toward collapse. Banks, still fragile from previous crises, began restricting loans. Small businesses struggled to finance operations, factories slowed production, and unemployment crept up once more. The stock market, which had climbed steadily for months, began to wobble. Investors who had leveraged themselves heavily faced margin calls, and panic began to spread quietly through Wall Street. The agricultural sector suffered enormously, the narration emphasizes. Farmers, already burdened by droughts and debt from the Dust Bowl era, saw crop prices collapse again. Communities reliant on a single industry began to crumble. Families who had survived the worst of the Depression faced the unimaginable. Ruin once more. The human cost was staggering but often lost in economic data. Workers who had regained jobs were laid off again. Children witnessed their parents' despair as homes were foreclosed. Small-town banks, once the lifeblood of local communities, closed doors permanently. The lessons of the 1929 crash had not been fully learned, and history repeated itself in a quieter, more insidious way. Patterns are powerful, the voiceover continues. Once the cycle begins, it is difficult to stop. Speculation, overconfidence, debt, and human error form a repeating pattern across decades. And yet, even amid the devastation, few truly understood the magnitude of what was happening. Newspapers reported bank failures and industrial slowdowns, but often buried the personal stories of suffering. Wall Street analysts debated figures in quiet offices, attempting to predict the next collapse. But the system had already spiraled beyond simple control. The documentary draws parallels to modern times. Hyper-connected global markets, excessive debt, and over-leveraged investments mirror the same fragile conditions of 1937. Just as small failures then led to widespread collapse, a minor shock today, unexpected interest rate hikes, political unrest, or corporate scandals could cascade globally. History is not just a record of the past, it is a blueprint for the present, the narration warns. The mistakes of 1937 echo in today's economies. Overconfidence, policy errors, and unchecked speculation can, and do, repeat themselves. Personal stories from 1937 make the narrative visceral. A small farmer in Kansas losing his land for the second time in a decade. A factory worker in Detroit watching the factory he rebuilt close due to lack of credit. A young couple in New York City forced to sell their home, their dreams collapsing alongside the market. Experts interviewed in the documentary reflect on the invisible forces shaping economies, shadow banking systems, speculative bubbles, and public perception. Each factor, seemingly minor on its own, contributed to a system-wide failure. This systemic fragility demonstrates that markets are not governed solely by logic, but by collective human behavior, fear, and hope. By studying 1937, we see the blueprint for what could happen again, the narration stresses. From excessive debt accumulation to rapid market speculation, the parallels to today are unsettling. We ignore history at our own peril. The middle section also explores how government interventions, intended to stabilize the economy, sometimes accelerated the decline. Credit restrictions, tax hikes, and misguided monetary policies forced industries to contract, creating a domino effect that rippled through communities, cities, and states. And yet, even in despair, there are lessons, the narration concludes. Understanding the hidden forces behind the 1937 crash allows us to anticipate dangers before they strike. Awareness, foresight, and action are our shields against repeating the mistakes of the past. As Section 2 closes, viewers are left with a chilling awareness. The events of 1937 were not anomalies. They were patterns, human tendencies that repeat across decades, often unnoticed until disaster strikes. The tension rises, setting the stage for the final section: consequences, lessons, and the urgent need to prepare for the future. The lessons of 1937 are as stark as they are timeless. Markets crash, economies falter, and ordinary people pay the highest price. But understanding history is the first step toward preventing it from repeating. The 1937 crash was not simply a series of unfortunate events. It was a consequence of predictable human behavior, policy missteps, and systemic fragility. As the world slowly realized the scale of the 1937 collapse, governments scrambled to respond. Emergency measures were introduced, banks were stabilized, and industrial production slowly resumed. Yet for many, recovery came too late. Lives were irreversibly changed. Families lost homes, children lost opportunities, and communities lost faith in the system. These human costs are the real measure of economic collapse, often overlooked in charts and graphs. History does not just repeat, it whispers first and then it roars. The narration continues. The same forces that created instability in 1937, over-leveraged debt, speculative bubbles, unchecked human greed, are present in today's economy. Rising global debt, volatile markets, and excessive reliance on speculation all mirror the patterns of the past. The modern parallels are impossible to ignore. Global markets are interconnected in ways unimaginable in 1937. A failure in one sector can trigger a domino effect worldwide. Shadow banking, high-risk investments, and rapid technological disruption create vulnerabilities that echo the preconditions of the 1937 crash. Without foresight, these patterns could culminate in a disaster even larger than history's memory. Yet there is hope, the voiceover asserts. Understanding the past allows us to act differently. Transparency, regulation, and financial education are the shields against repeating history's mistakes. By learning from 1937, society can build safeguards to protect the vulnerable, stabilize markets, and prevent unnecessary human suffering. The human element remains central. Families who once lost everything can rebuild, but only if systems are in place to prevent the recurrence of mass collapse. Economists and policymakers emphasize early warning signs: rapid credit expansion, overspeculation, and ignoring subtle market shifts. By recognizing these patterns, society can act before panic spreads. The consequences of ignoring history are profound. The narration continues. Economic collapses are rarely isolated. They ripple through communities, disrupt governments, and redefine lives. The world cannot afford complacency. Every warning ignored brings us closer to repeating the tragedies of the past. The cinematic presentation of this section emphasizes both despair and hope. Citizens protesting economic inequality and loss. Families rebuilding homes after financial ruin. Government officials and economists analyzing markets, searching for early warning signs. Children learning about financial literacy, symbolizing long-term prevention. Global markets visualized as interconnected webs, fragile yet vital. In 1937, the world learned hard lessons the first time, the narration reflects. Today, those lessons are waiting for us to remember. The signs are visible, the patterns are clear, and the human cost is at stake. We can ignore them at our peril, or act to change the course of history. The documentary closes with a reflective, emotional tone. History is more than a record of what has been. It is a mirror showing what could happen if we fail to learn. The 1937 crash was a warning carved into human lives. Its echoes are with us today, whispering the same message. Be vigilant, be informed, and act before disaster strikes. Because the past never truly dies. It waits for us to listen. The final imagery fades to a slow montage of hope. Sunrise over a city skyline, hands breaking chains symbolizing freedom from debt, and communities coming together to rebuild. A globe spins slowly, highlighting economic centers as lights blink, representing vigilance, knowledge, and readiness. The narration ends on a strong, haunting note. Remember 1937, learn from it, and act before history repeats itself.